Let's talk money.
Hello and welcome to Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, 2025 taught us the importance of having a well-diversified portfolio based on a clear asset allocation strategy. It was not only about equities. That's what that year taught us. Fixed income is an important part of that balanced portfolio. But many times we don't give this asset class enough thought and rely only on our legacy fixed deposits or the money that's lying by default in our bank accounts. So today on the show, we will talk about the outlook ahead, first of all, for the debt markets in 2026 and why you may want to consider some interesting fixed income funds for investment in the current environment so that you do have that well-diversified portfolio. Well, let me welcome on the show my guests, Devang Shah, Head of Fixed Income at Axis Mutual Fund, and Aditya Pagaria, Senior Fund Manager, again at Axis Mutual Fund. Gentlemen, thank you very much for joining in. And first of all, greetings of the new year to you. Thank you so much for joining in. So like I said in the opening remarks, investors pretty much, I think, are guilty of this. It becomes a very, very equity-dominant conversation. Now it's a gold and silver-dominant conversation. But we realize that personal finance needs to be more scientific than just following the latest trend, right? So here we are. Welcome to the show. Devang, I want to start by getting opening thoughts from you on why it's important to consider debt funds and not be lazy and just talk about, okay, I have enough debt, I have some fixed deposits, so why should I bother?
Yeah. So thanks, Surabhi, and I wish you a happy new year and all your viewers a very happy new year. To start with, as you rightly highlighted, I think what is important, and in the last 2 years specifically, where there was complete volatility across all asset classes, you need certain stability in your portfolio. Fixed income is all about stability, and somewhere down the line, how do you build that less volatility in your portfolio basket? So our understanding is at this point of time also, and if you look across the last 2 years where equity performance has remained quite patchy, fixed income, if you look at categories like gilt, if you look at categories like short to medium term funds, all of these categories have given around 8.5 to 9% kind of returns. So we believe so that obviously on the basis of the macro environment, it is important first of all from a perspective of asset allocation, as well as from an overall investment thesis to always have fixed income in your portfolio basket. Now, the allocation would obviously is important, and there are bases and factors which you should consider. One is your investment horizon, one is your overall risk appetite and your return expectation. These are some of the important variables which you should always keep in mind while deciding your fixed income allocation.
No, absolutely. And we're going to talk about a lot of this as we go along. But before we get started, it's really important to understand the basics of fixed income investing. And Aditya, let's do a very quick classroom one-on-one so that our viewers understand that the way you make money is either you hold a bond to maturity. So what is the yield that you're getting on that bond? That's one way of it. And the other is the price of the bond. And the price is inversely correlated to the yield. So many times these prices move. And as what Devang just described, because of several factors, bond prices were doing very well. Interest rates were coming down in the last 2 odd years. Bond prices were doing very well. And investors, if they were rightly positioned, managed to make some gains. So let's just decipher this whole phenomena of accrual. I know that's a word that you gentlemen will use quite often now in this conversation. And the concept of duration and duration risk. So let's clear the basics and then we'll continue.
Sure. Thanks, Surabhi. So I understand that these nuances that are typically used in a fixed income conversation needs to be clear for the audience. So basically, as you rightly explained, fixed deposits have a fixed coupon. And that is something what differentiates it, what the fixed income market rates. So we have bonds that have a fixed coupon, but depending on the market scenario, the price of it varies. For example, as you said, it is inversely related to the yield. So when the yield goes up, the price goes down and vice versa. So typically accrual is basically the coupon that you are earning on that particular paper. So for example, the higher the accrual, the higher the coupon, better for the investors, for the market. The other thing, other terminology that we use typically that we have given in our note is the barbell strategy. So barbell is nothing but basically if you typically look at a fixed income yield curve, it is an upward sloping curve. So there is a shorter end of the curve and there is a longer end of the curve. Longer end in the sense, it's an upward sloping curve wherein, the more time you hold the bond, obviously you need to be compensated with a higher coupon rate. So these kind of strategies work in different scenarios. So barbell is a strategy wherein you hold the shorter end of the curve. That is typically a 1 to 3 year kind of corporate bond, GSEC, or different type of asset types in the fixed income. And barbell is on the other side, we are holding the longest maturity of the bond. So these are the barbell strategy, the shortest end and the longest end. That is what we call as the barbell strategy.
Okay, and we're going to talk more about this because it is this barbell strategy that Axis Mutual Fund is advocating in the current interest rate and the macroeconomic environment. So we'll talk more about it. We'll keep demystifying this as we go. But let's first understand the environment. So Devang, now over to you for this. Like you explained, the last 2 years have been very good for the fixed income market. But now many will argue that maybe we're coming to the end of the rate cut cycle. So if the RBI stops cutting interest rates, would the expectation of more gains, bond price gains, would they diminish? What does the end of the rate cut cycle really mean for fixed income?
Right. So as you rightly highlighted, I think there are 2 or 3 levers on how do you make money in fixed income. You spoke about it, but one is accrual, one is duration, and the other part is on the selection of the curve. We believe that somewhere down the line, from a macro perspective, we are at the fag end of the rate cut cycle. And we have done, I think RBI has done a superb job. And probably if you look across at all the measures, we have done more than 15 lakh crores of liquidity infusion. We have done 125 basis of rate cuts. So in the last 12 to 13 months, we have done a lot of monetary policy actions. We believe from here on, when I look across at and when I look at from an RBI's lens perspective, there will be 3 or 4 perspectives which RBI will focus on. One, how is the inflation trajectory going forward? We believe that we are at the bottom of the inflation cycle because our view is that if you look across it incrementally, the base effect will start working against. Commodity prices started shooting up. You spoke about commodities. It's not only precious metals. Let's look across the base metals also now. Copper, aluminum, steel, all of these prices started increasing. So somewhere down the line, this will start hitting inflation. So the bottom of the inflation is behind us. 1 year forward inflation looks to us closer to around 4 to 4.5%. Secondly, another important driver for rates always has been the growth cycle. We believe, yes, growth continues to remain patchy because of the tariff overhang. But in today's market environment, when I look across the high frequency indicators, we are not anywhere close to slow down that where RBI needs to do more. RBI has done already a lot of rate cuts. RBI can remain a bit supportive. But incrementally from here on, from a monetary policy perspective, where inflation is now on a U-turn, I think somewhere down the line, the opportunities for RBI to cut rates will be limited. The third aspect is on a fiscal consolidation basis. I think we did a superb job on fiscal consolidation over the last few years. We have come down from all the way from center's fiscal deficit number from 7% to 4.4. And next year also, we believe that the fiscal deficit will be closer to 4.3, 4.4%. So incrementally from here on, fiscal consolidation looks limited to us. Now, in this environment, and when we are looking at from an external stability perspective, where rupee continues to weaken, I think room for RBI to cut rates looks very, very limited. And yes, unless there is a big shock to the growth, and if this tariff rate continues or we see some more tariff rates to be introduced on India, I think that we are nearing the end of the rate cycle. And we believe that RBI in 2026 will be on a long pause. Because inflation still hovers around 4.5%. There we are not seeing a significant upside because we are going to see the U-turn in inflation. Q1, Q2 inflation might still be below 4%. It's where the Q3, Q4 calendar year inflation will start inching up. We believe that somewhere down the line, if there are no rate cuts, similarly, there are no rate hikes for the year. So 2026 will be probably a year of rates remaining lower, and it might be a pause from RBI. So it's a lower for longer rate regime.
So Devang, that's very well explained why you believe the RBI is just going to be on pause. We'll not say rates go down, we won't see them go up. What does that mean for a fixed income investor? And broadly, we'll get into the details in a bit, but just in a nutshell, in this environment, what is the fixed income strategy to have?
Right. So we had been advocating in 2023 onwards, late 2023 onwards, that duration is the play. And in 2025, in fact, in mid 2025, we came up with a communication also stating to our clients and investors that probably the liquidity cycle is going to significantly improve and probably the curve will steepen. So invest in the short to medium term funds. In 2026, our assessment and view is that largely, as I told you, we are behind the best of the liquidity cycle, best of the inflation cycle, and best of the fiscal consolidation. What does this mean in simple terms for investors? I think investors first needs to gradually and significantly reduce their duration. So at this point of time, we are advising clients that they should be probably looking at the significantly short end of the curve on fixed income. Secondly, you highlighted that we will be talking about accrual. And we believe that in a year where there is stable rate regime, accrual plays an important role. And in an environment where there's a lot of volatility, I think accrual will provide a lot of stability to your portfolios. So the two fixed income themes which we are talking about is one, significantly lowering the duration for portfolio investments. And secondly, build in accrual as a theme in your portfolios.
Okay. And if I could just ask you to name the fixed income categories in general, which provide a play on the themes that you just described, which would the fund categories be, Devang?
So see, we have always understood that investors now look, and post 2023, the tax efficiency going across, we have always looked at investors look at opportunities on fixed income in 2 or 3 perspectives. One is they're looking at parking solutions, where they are looking at, you spoke about it, that there's a lot of lazy money floating around in various traditional solutions. For parking solutions, what we advise clients is a money market kind of fund, which makes a lot of sense for investors who are looking at shorter term investment horizons, looking at just a good deployment of their short term money. The more medium term and long term category in this environment, where you are looking at a stable rate regime and probably you also targeting a tax efficient solution. Last year's tax bill gave us some clarification and good opportunities in a new category, which is income plus arbitrage fund of fund category. We believe that this category incrementally going ahead makes a lot of sense for investors who are looking at a medium term debt solution. So these are the two categories which I generally advise depending on their investment horizon. Short-term investment horizon, I would probably say a parking solution like money market category. A medium-term investment horizon, an income plus arbitrage fund of fund category makes a lot of sense. For investors, you spoke about it that investors generally don't look at tactical opportunities, but we have already seen because of this mammoth increase in SDL supply. And in this year, I think the last, just few days back, we got the last quarter SDL supply, which is around 5 lakh crores. We
SDL, Devang, now this is Let's Talk Money. We have to keep it simple. Now, for the benefit of our viewers, just saying, when he says SDL, we're talking about state development loans, right? State governments have been issuing a lot of debt, they've been flooding the bond market with a lot of paper, and the bond market has had to absorb that supply. Devang, please continue.
Yeah, so sorry. So the state government securities, we have seen a huge supply this year. I think probably they will be looking at a gross issuance of around 12 lakh crores. So that significant supply has led to the spread widening for state government securities. Traditionally, these spreads were 30-50 basis over so many years. If I talk about trend of last 10-15 years, they are currently trading at in the spread of around 70 to 90 odd basis. So we believe that there are some opportunities for investors who are looking at some kind of medium-term and long-term investment horizon. I think this category also, like gilt funds with higher allocations to state development security, also makes a lot of sense. Okay. So I would say 3 solutions: money market, income plus arbitrage fund of fund, which are more basis of accrual and low duration. And the third part is, which is more focused on because of this theme coming across, where state government security spreads have significantly widened, you can have some allocation to gilt funds.
Okay, all right. So that's a full strategy that Devang has laid out. We'll take a break and then we have lots of follow-up questions on the strategy. And remember, Aditya spoke about the barbell approach. So how do we understand that? We'll discuss it after the break.
Let's Talk Money